All right. Welcome everyone, and thank you for attending today's hearing. I'm Brad Bowman. I'm the Chief Actuary at the Maryland Insurance Administration. I'm filling in for Marie Grant, our commissioner. She could not be here today, unfortunately. This is the Maryland Insurance Administration's fourth regular public hearing in 2025 on specific carrier rate increases for long-term care insurance. Today's hearing is going to focus on two rate increase requests in the individual long-term care market before the MIA. These include requests from Genworth Life Insurance Company proposing an average increase of 108% for policyholders on Form 7052MD, and also introducing a new standalone 1% compound benefit increase option for policyholders on Form 7035AT. And then we have Life Secure Insurance Company, who is proposing an average rate increase of 76% for policyholders on Form LS-0002, and an average increase of 41.4% for policyholders on Form LS-004 and LS-005. These requests affect a total of approximately 3,966 Maryland policyholders. The purpose of this hearing is for the insurance company officials to explain the reasons for the rate increases and for the MIA to consider whether the proposed rate increases are in compliance with Maryland's laws and regulations related to long-term care insurance. We will also listen to comments from consumers and other interested parties. We are here to listen and ask questions of the carriers and consumers regarding the specific rate increase requests. I would like to take a moment to introduce my team who is here with me. I have Jin Shin, who is the senior actuary in charge of long-term care rate filings, and then I have Antoinette Najiki, who is a actuarial an analyst reporting to Jin. I'm going to review a few procedures we're going to follow today. When it's time for public comment, we will call on the first members of the public who register to speak in advance. To the extent that time and technologies permit, the MIA will hear from unregistered participants who access the Zoom webinar platform or who have attended the hearing in person. If using Zoom, you can communicate with us through the chat function, please. With the exception of the MIA staff, this hearing is not a question and answer forum. Comments from interested parties were received and reviewed in advance of this meeting. The MIA will continue to keep the record open until Tuesday, December 23rd, 2025 for any additional written testimony. A video of today's meeting, as well as all the written testimony submitted, will be posted on the MIA's website on the long-term care page. The long-term care page can be found on the MIA website by clicking on the Consumers tab at the top of the homepage and then clicking the long-term care link. To help ensure excellent sound quality throughout the hearing, we ask that you please stay on mute unless you are speaking. Also, anytime you are speaking, if you could please restate your name and your position clearly, that would be a great help. Thank you. We will be asking the carriers to speak first regarding their rate requests. Afterwards, any interested stakeholders will be invited to speak. I will now turn it over to the carriers and allow them the opportunity to discuss their pending rate increases. The first carrier that we have is Genworth. So if I could have the representative for Genworth, please speak up.
This is Matthew DeRose from Genworth.
Hey, Matt.
Should I go ahead and start?
Yeah, the floor is all yours.
Thank you. So, good afternoon. My name is Matthew DeRose. I'm a CPA licensed in Virginia, and I work in Genworth Life Insurance Company's long-term care in-force business unit. Chief Actuary Bowman, thank you, and the Maryland Insurance Administration team for holding today's virtual hearing and for providing GLIC and our policyholders an opportunity to discuss our long-term care insurance policies. I'd also like to thank all the policyholders for your interest and participation. GLIC understands that your long-term care insurance coverage is important and welcomes this opportunity to participate in this hearing. Genworth understands that our ability to support service, and protect you, our policyholders, is of absolute importance. We take this very seriously and affirm our commitment to being there for our policyholders when they need us. Glick has been selling long-term care insurance in the state of Maryland since 1978 and currently provides coverage for approximately 26,000 Maryland insureds and approximately 1 million insureds nationwide. I'm here today to speak specifically about our current long-term care premium rate increase filing, which is pending with the Maryland Insurance Administration. Glick understands premium increases can be difficult for our policyholders, so we are committed to providing information that explains why rate increases are needed. We also want to discuss the various options we offer to our policyholders and the ways we assist each of you to make informed choices about your specific LTC insurance needs. Glick is currently seeking a rate increase on our Flex One product. It is the only product with a current pending rate increase filing in Maryland, but we will continue to seek rate increases on other products in Maryland and nationwide. When we price this policy form, we utilize professional actuarial judgment to develop assumptions that look forward as many as 60 years into the future. In keeping with our actuarial precepts and standards of practice, Glick employs our best efforts to complete a thorough professional assessment at the time of original pricing and as we evaluate the blocks on an ongoing basis. Since this policy form was priced, claim information, which informs our assumptions, has increased significantly for Glick. We have seen that claims continue to cost more and occur with higher frequency than originally anticipated. Yet we are sensitive to the impact that these rate increases have on policyholders, and Glick is sharing in the cost of these necessary rate increases. We have stated publicly that all proceeds from approved LTC premium increases would remain in Glick and be used for the sole purpose of paying LTC claims, and that none of the benefits from approved LTC premium increases would ever be paid to Genworth Financial, its shareholders, or other stakeholders other than Glick insureds. These blocks of business are being managed solely for the benefit of insureds. Genworth has a high concentration of policies with a compound benefit increase option at about 57% of policyholders. 37% of policyholders has a 5% compound benefit increase option. Due to these inflation options, these policies typically have the richest benefits and are expected to have the largest claims. In 2022, Genworth began differentiating rate increase requests based on both benefit period and level of benefit increase options for most policy forms to address specifically the potential future experience associated with these options. It is our intent to act in a timely manner and work diligently with regulators to obtain approval for the full amount of the proposed rate increase, with the understanding that delays can lead to a larger ultimate rate increase. As it relates to the specific rate increase request at this time, for Flex One product series, Glick issued policies to Maryland residents from November 2011 to September 2014 under policy form number 7052MD. The rate increase request varies between policies with unlimited versus limited benefit periods, as well as policies with low benefit increase options, less than 3%. Versus high benefit increase options, either 3 or 5%. We're seeking a premium increase of 180% for policies with unlimited benefit period and high benefit increase option, 129% for policies with an unlimited benefit period and low benefit increase option, and 105% for policies with a limited benefit period and high benefit increase option. Acknowledging Maryland regulation, Glick would be willing to implement the requested rate increase with no more than 15% increase in each year, or over 11 years for policies with an unlimited benefit period and high benefit increase option, 8 years for policies with an unlimited benefit period and low benefit increase option, and 7 years for policies with limited benefit increase option and high benefit with limited benefit period and high benefit increase option. The rate increase will impact approximately 3,000 policyholders. This policy form has received 2 prior rate increases, leading to cumulative amounts of 67.4 for policies with high benefit increase options and 26.6% for policies with low benefit increase options, with no increase exceeding 15% in any single year. Glick will continue to evaluate whether additional rate increases will be needed as experience continues to emerge. Premium increases result in a very important and impactful decision for many of our policyholders. We know this because we talk to our customers every day and listen to their concerns. To support our policyholders, we have a dedicated team of specially trained customer service representatives whose sole responsibility is to take calls related to rate increases. Our customer service representatives are ready and willing to help our policyholders understand their options so they can determine the best course of action for their individual situation. We also have websites that provide policyholders with helpful information on why increases are needed, options they may have, the value of coverage, and frequently asked questions. We continue to offer policyholders subject to a rate increase a variety of options. They can choose to, one, pay the full amount of the rate increase and maintain the current level of protection. From our overall nationwide experience on the rate increases we've implemented since 2012, even with the variety of options provided, we have seen approximately 39% of our insureds choose to pay the higher premiums as of October 31st, 2025. Or instead of paying the full increase, our policyholders can make customized benefit adjustments to find the right balance of affordability and protection for their individual situation. For our Flex One policyholders, Genworth offers a 1% compound benefit increase option that policyholders who already have a benefit increase option, that's the 3 or the 5%, can select to reduce their benefits. For policyholders who decide not to pay any future premiums and who do not otherwise qualify for another option to maintain their coverage while ceasing to pay premiums, you voluntarily offer a non-forfeiture option that equals a paid-up certificate. With this option, if the certificate holder becomes eligible, GLIC will reimburse eligible expenses up to the amount of premium paid minus any claims that we previously paid. In addition, a certificate holder will still have access to the care coordination services our company provides. Additionally, for our Choice One policyholders, while there is not a pending rate increase filing, we have submitted for approval a similar version of the 1% compound benefit increase option. Policyholders who already have a benefit increase option who elect this option may retain their higher accumulated daily or monthly maximums with 1% compound increases going forward. We're also expanding our Live Well, Age Well wellness program to reach more insureds earlier in their claim journey. Since 2022, our clinically trained team has offered one-on-one coaching and support for policyholders nearing an expected claim. We've recently introduced daily living aid kits that may assist with key risk areas like fall prevention and home safety. These services are available to policyholders at no additional cost. Currently, this program is available to certain policyholders with our Choice One product and to policyholders on other policy forms that are near claim and have reached out to our customer service team. We have seen strong engagement and a very high satisfaction rate nationwide. We plan to continue to expand our Live Well, Age Well program in the future. We introduced the Care Quality Network, or CQN, in 2023 and have expanded to many states, including Maryland. The CQN is the first network of its kind and helps consumers find high-quality care with preferred pricing. The CQN consists of a diversified network of long-term care providers who have undergone a thorough assessment. I hope that the comments today have demonstrated that GLIC actively manages our business to try to ensure that we will be here for our policyholders when they need us most, to make sure we are available to provide the answers you need, and to pay eligible claims if and when those needs should arise. As of year-end 2024, GLIC has paid over $31.6 billion to our insureds on nearly 384,000 claims for eligible long-term care benefits. GLIC is committed to keeping our promises to our customers and paying all eligible claims, but again, actuarially based premium rate increases or policy adjustments are important to our ability to do so over the life of these policies. GLIC is in a unique position relative to other carriers with a material LTC concentration. GLIC has over 84% of total current reserves dedicated to LTC, which is expected to continue growing in the future. As I previously noted, all proceeds from approved LTC premium increases will remain in GLIC and be used for the sole purpose of paying LTC claims. None of the benefits from approved LTC premium increases will ever be paid to Genworth Financial, its shareholders, or other stakeholders other than GLIC insureds. In fact, GLIC has last paid a dividend to our holding company over 10 years ago in 2015. In conclusion, the Genworth remains committed to working with the Maryland Insurance Administration to implement actuarially justified rate increases in a reasonable and responsible manner, keeping in mind policyholder interests and concerns. Genworth appreciates the opportunity to participate in today's hearing. I'd be happy to answer any questions from your team.
Thank you very much, Matthew. I have a question. So you talked about the rate increases that were being filed. Am I interpreting it correctly that those with limited/low benefits are not getting any rate increase?
So let me So it's on the three cohorts, only two of which we have policyholders, but we did file for an increase on a third cohort because policyholders can reduce their benefits down into that. But that's limited benefit lifetime benefit period, high bio, limited benefit period, high bio, where we both have policyholders. And then also the third cohort is lifetime benefit periods and low bio because policyholders can RBO or reduce their benefits down into that cohort. And so we're requesting increases there from the original pricing or from previous pricing.
Okay, so limited low is not getting any increase, right? They're
Correct.
excluded.
Yeah. Yeah, correct. Yeah. Limited
Okay.
benefit period, low bio, correct.
All right. And then you talked about the 1% option that exists for the flex period for the flex one policies and it's being filed for the choice one policies. So if a policyholder elects that option to confirm, that doesn't change what they've already accumulated to date. If they have a 5% or 3% buyout, it only changes things going forward, right? They keep their
Correct.
accumulated value at the
Correct.
higher level.
And that's solely for folks who have either a 3 or 5% already can reduce down to that 1%.
Okay, and that's not like a limited time offer, right? That's like a new option that's gonna be there going forward. Basically every renewal.
Correct. Yeah. Historically, we've filed those alternatives with a rate increase filing. Here was the first time we're doing it independent of a rate increase filing, but works just like it would on Flex One.
Okay. Jen, do you have any questions?
Yes, thank you. In our state, we have only 64 policyholders in lifetime benefit high bio and 2,900 policyholders in limited benefit high bio option. I was curious why lifetime benefit option was not very popular when it was sold 12, 13 years ago. Was it due to high price or any unreasonable benefit structure, or if there were any other reasons? I think same thing happened for the nationwide experience. The lifetime benefit, for some reason, was not very popular and didn't sell a lot compared to limited benefit. I was wondering, why that was the case.
I don't have that information. I know we certainly have more, the lifetime benefit period policyholders and some of our older policy forms. On this one, I don't know specifically what drove that at the time this was sold.
Okay. And another question I have is for lifetime benefit high bio option, even though we have only 64 active policyholders in our state, after your requested rate increase of 180%, the annual premium will be in the range of $16,000 a year, which seems huge. And I don't know if our senior citizens in fixed income could be able to afford that kind of price. So I was just making that comment. How can we manage going forward this tremendous rate increase in the future, considering the fixed income situation for our senior citizens?
Yes, when thinking about affordability, some of these concerns, I think there's two pieces to that. One is the cost of the insurance premium itself, and then is what does it pay for, right? What is the premium leverage relative to their benefit pool? So you look at that premium that you stated. The benefit pool is unlimited, right? It's infinite. Certainly accessed at a certain pace, which is their daily or monthly maximum, but that's an unlimited, infinite amount of benefit there. So I think there's still tremendous value when thinking about the premium dollars leverage to the benefit pool. And then the other side of that is that's really being driven by cost of care here in the United States, where Genworth is absorbing as much of that cost as we can and sharing in that pain with our policyholders. Experienced quite extensive losses on these policy blocks historically, and so we feel that pain as well in terms of the cost of care. but that's what's driving these increases.
Mhm. And on the 1% compound bio option, I guess what's important here is that we need to verify the rates are reasonable, in compared to 3% bio compound or 5% compound bio or no inflation options to make sure that when we interpolate or extrapolate that the rates are kind of in line, reasonable compared to other bio options. Is that correct?
Yes, I understand. If you have, specific questions on that, I can't speak to the exact pricing and the relationships here, but more than happy to follow up with more detail on the pricing if you need that.
Do you have any expectation, like what would be policyholders' intention would be if this becomes available? Do you anticipate big shift or not much reaction or any kind of anticipation that you have?
On the choice on the choice one, where we're just adding the 1% bio.
Yeah.
I don't think we have enough experience yet. We just started filing that nationwide a couple of months ago. So I don't think we have enough experience, right? This is the first time, as I mentioned, that we've offered this, standalone outside of a rate increase. So I don't know if we have enough data to be able to answer that comfortably just yet.
Okay. Thank you.
Yeah.
Oh, I have one more question. You talked about the CQN. I think it was the Care Scout quality network.
Mhm.
So to clarify, that's an optional network, right? Policyholders are not required to utilize a CQN provider to obtain benefits, correct?
Correct. Yeah, good question. And yes, correct. It is fully voluntary, just there for the policyholders' benefit. But it is, as I mentioned, a nationwide network now of I think we're in almost every zip code across the country. Primarily home care providers right now, looking to expand into other into facility in the future. But right now, home care providers that again go through an extensive vetting process and do offer discounted pricing to our policyholders.
And policyholder can find a provider directory on your website, or how do they locate a CQN provider?
I don't believe we have that on our website. They would have to call in. Again, typically these are people who are already maybe in the claim process, and so dealing with customer service, but they can at any time call into customer service and receive that assistance if they need.
Okay, thank you.
Yeah.
All right, that's all the questions I had. Jen, if you don't have any more questions, then this can conclude the general testimony.
Mhm.
All right, thank you. Up next, we have LifeSecure Insurance Company.
Hi, my name is John Brandenburg, and I'm an associate actuary on the actuarial pricing team for LifeSecure's long-term care insurance business. I'm joined by Jason Bushy, our Senior Director of Actuarial and Risk Management. Thank you, Mr. Bobin and the Maryland Insurance Administration team for holding today's virtual hearing and for providing LifeSecure and our policyholders an opportunity to discuss our long-term care insurance policies. I would also like to thank all the policyholders for your interest and participation. LifeSecure understands that your long-term care insurance coverage is important to you, and we welcome this opportunity to participate in today's hearing. LifeSecure understands that our ability to support, service, and protect you, our policyholders, is of absolute importance. We take this very seriously and confirm our commitment to be there for our policyholders when they need us. LifeSecure acknowledges how difficult premium increases are for our policyholders, so we are committed to providing information that explains why rate increases are needed. I'm here today to speak specifically about our current long-term care premium rate increase filing with the Maryland Insurance Administration for our LTC 1.0 and LTC 2.0 products. Our two products cover three forms: LS-0002, LS-LTC-0004, and LS-LTC-0005. Our LTC 1.0 product encompasses form LS-0002, and our LTC 2.0 product encompasses forms LS-LTC-0004 and 0005. This is our fourth filing for our LTC 1.0 product. Our first and third filings for this product were approved for 5% and 15% rate increases, respectively. Our current request is 93% for form LS-0002. As for our LTC 2.0 product, this is our third filing. Our first two filings were approved for 14.4% and 10% on our LS-LTC-0004 form, and 10.7% and 10% for our LS-LTC-0005 form. Our current request is 49.6% for form LS-LTC-0004 and 47.1% for form LS-LTC-0005. One of LifeSecure's priorities is to ensure our claim paying ability for all our policyholders. The rate increase request is necessary due to changes in our expectation of future claims. We recognize that the experience for this block is limited, but we want to act early to prevent larger future rate increases. We rely on industry data to set morbidity assumptions, and we have no reason to think that LifeSecure's experience will vary materially from the industry's. The source of our current morbidity assumptions is the same as original pricing, meaning the morbidity assumptions come from the same consultant that published the morbidity study used at pricing. The only difference is the date the study was performed. Ideally, this consistency helps to isolate the impact of the changing environment over time and shows that expectations have indeed gotten worse. LifeSecure is offering options to help its policyholders cope with the rate increase. A policyholder may reduce their benefit, reduce or remove inflation, or remove any other rider. If a policyholder removes inflation, they can choose to keep their benefit at the current inflated level. It is only the future accruals that stop. Finally, if a policyholder purchased the lapse protection rider, they may, of course, exercise that benefit, which provides a reduced paid-up benefit, meaning no future premiums, rate increases, or otherwise would be due. This rate increase will impact approximately 124 LTC 1.0 Maryland policyholders and 878 LTC 2.0 Maryland policyholders, for a total of 1,002 Maryland policyholders. In conclusion, LifeSecure remains committed to working with the Maryland Insurance Administration to implement actuarially justified rate increases in a reasonable and responsible manner, keeping in mind policyholder interests and concerns. Mr. Belvin, LifeSecure appreciates the opportunity to participate in today's hearing, and I'd be happy to answer any questions from you or members of your team.
Thank you very much. So your rate increases only vary by policy form and don't vary by, benefit type, like limited versus unlimited or inflation option. Is that correct?
Correct. You are correct.
All right. And that's true of the past approved increases as well. You've always asked for a flat increase across the whole block.
Correct. Yeah. The rate increases that have been approved have always been a flat increase across the block.
All right. Thank you. Jin, do you have any questions?
Yes, I have a couple of questions on LS2 and a couple of questions on LS4 and 5. On LS0002, your actual rate increase requested is lower than the original increase because of the rate cap. Could you please explain in little more detail on the rate cap, please?
Yeah, we currently sell our LTC 3.0 product. And one of our rules is that we cannot have our previous products like our LTC 1 or LTC 2 that fit in the same dimensions that are currently selling product, our LTC product. We can't have those rates exceed the LTC 3 rates. So when we ask for a rate increase, it is going to be limited to what we're currently offering. Therefore, policyholders that are under that same criteria that the LTC 3 product is being sold, the ones that we currently have in force for LTC 1 and LTC 2, they will not exceed LTC 3 rates.
Got it. Thank you. So 93% came down to 76% in reality. Okay. Second question on the LS2 is that I want to say thank you for providing the cumulative rate increase data for each state. And I would appreciate it if you can send us the number of actual policy active policyholders for each state as well.
Yep, we will get that to you.
Great, thank you. On LS4 and 5, with 41% requested rate increase, your lifetime loss ratio will be about 65.7%, which is very close to your original price to loss ratio, I would assume. So
Yes.
these experience is running really well, and compared to other companies, I would say. But yet you still, want to increase the rates by 41%. It seems a little bit kind of premature at this time for substantial rate increase like 41%. I don't know what you feel about that.
Yeah, it's a great question, a great concern that you're bringing up. I think if you look at, our LS002 product, we're asking for a 93% rate increase.
Right.
And, ideally for our 0004 and 0005, forms, we don't want to get to a point where we're asking for 93%. So we want to, stay ahead of that curve, so that we don't get to a point where we're asking for 93% or even more.
Okay, so you want to stay proactive and try to manage the rate increase in a reasonable amount, each time, experience justifies it. Okay, thank you.
Yes.
And the second question I have is, when I look at the average attained age of the Maryland policyholders, is 62 years old, very young. So I would not anticipate much claim activity in the near future because of the younger age of active policyholders. So again, I think this is a kind of positive that your loss ratio is not going to go up substantially in the near future. Just wanted to make that comment.
Yeah, and again, I think to speak to the point earlier, ideally we would like to, get ahead of this rather than if we were to ask for a rate increase and that rate increase could be, 100%, 200%. We don't want to be, we would ideally we don't want to be asking for those large rate increases when claims are due. So yeah, again, we would like to, ask for these rate increases, obviously sooner rather than later, so that we don't get to a point where we are asking for triple-digit rate increases.
Great, thank you. That's all I have. Right.
Great, thank you very much. Thank you, John, for your testimony. Appreciate it. At this point, we'll move to consumer testimony. We didn't have anybody signed up in advance, but I see there's a hand raised in the Zoom for Howard and Terry. And so if Howard and Terry want to give some testimony, they can go ahead and do that.
Yeah, you're on mute.
Okay, sorry about that. I'm going to read a statement that I wrote earlier today, and it's not directed to anyone specifically, it's in generality. I appreciate the opportunity to participate in the Zoom session concerning the proposed price increases for existing policies, which could reach up to 15% compounded over the next 6 years. However, I struggle to understand why loyal policyholders who have consistently paid rising premiums for many years are now confronted with the possibility of being unable to afford their coverage. It seems unjust that despite the significant resources and expertise of highly compensated actuaries and their sophisticated algorithms, insurance companies are now, metaphorically speaking, coming hand in hand for relief due to potential impacts on their profits. profits. This situation appears to be occurring with the endorsement of the state and at the expense of already burdened taxpayers. I am unaware of any other industry where a business model can so adversely affect its clients while continuing to prosper. Long-term care underwriters seem to have created a system that allows them to profit despite failures in their financial forecasting. Meanwhile, executives at these companies continue to receive substantial salaries while their bottom lines flourish amid challenges facing policyholders. The rate increases that have been approved for Lincoln Financial, my insurer, are concerning. It's 15% compounded over 6 years that you approved. I strongly urge the state to take a proactive stance in support of individuals and taxpayers, ensuring that our interests are adequately represented. And I do not believe you have done that in the least at this point. Thank you very much.
Thank you for your testimony. Just to be clear, the rate increases being discussed today are proposed rate increases. They're not approved rate increases. We are still undergoing our review. But in general, the MIA does not approve what is requested in long-term care. Over the past 5 years, we've approved approximately 35% of the average requested increase. So I just want you to understand that it's unlikely based on historic, historic patterns that we're going to approve the full increase, and it's much more likely that we're going to approve a fraction of what's being asked for. So I understand that the numbers that the carriers are giving are very large and would be compounded over 6, 7, 10 years. But these are not yet approved. We will be approving something over the next couple months on these, but these are just proposals. And I understand where you're coming from and the affordability issue, and that's what we're trying to balance. You talked about profits in this industry, and unfortunately, these blocks are mainly losing money. They're not profitable, and that's what we're trying to balance. That these companies have these money losing blocks of business, and we need to make sure these companies are solvent and can pay out their claims and can honor their contracts with their policyholders. But we need to keep the premiums affordable. So that's the two things that we're trying to balance when we look at what we're going to approve. So I want you to know that we are taking this into account. And nothing here is approved, and the final approvals are likely going to be lower than what you're seeing today.
I understand your point of view on it, but I will tell you that when you approved for Lincoln Financial a 15% increase for 6 years compounded, it becomes an ungodly number. I had already reduced the waiting time to the maximum of 100 days. I am to take a policy now and destroy it by locking in their proposed values. The fact remains that these CEOs who run these companies and the profitability of these companies is absurd. You've got CEOs averaging between $6 million and $10 million a year. They don't seem to be suffering. But you take a retired individual and you compound the cost of the policy. Forget the fact that they pretend these ridiculous increases. the fact remains you take a policy and you increase it 15% for 6 years compounded, it becomes an unaffordable rate so that people that are retired and have put in tens of thousands of dollars already are then faced with the necessity to drop out because they can't afford the premiums. Don't you understand that if you can't afford the premiums, the policy is worthless?
Yeah, we definitely do understand that, and we are trying to balance affordability with, setting the premiums at a sufficient level to cover claims.
Do you know any other companies that could go to the state and get that kind of increase because they failed in their prognostications through algorithms and their actuaries? I don't know of any other place that this happens. You want to look at their bottom lines and say, my God, they're going out of business. They're not going out of business. They're playing us and the consumer for suckers.
All right, thank you for your testimony.
Thank you for my ability to participate. I do appreciate that.
All right, before we have another speaker who wants to speak, Mr. Thomas Scott. If you want to unmute yourself, you can go ahead and give your testimony.
Thank you, Brad. I have unmuted myself. Can you hear me?
Yeah, I can hear you great.
Very well. My question earlier in the chat was the option that Genworth, I'm a Genworth policyholder, 7035. The option that was presented by Genworth, is that a replacement or a modification of an existing option? They have currently 4 options, or 5 if you consider contingent non-forfeiture an option. So in their latest letter to us, this was back in, I always love this. You never can find a date. It should be like right at the top of the page. Anyway, it was for the increases that took place in 2024. And they gave like current situation, then they had 2 lifetime stable premiums. Okay. And then they had 2 where you could review and adjust your coverage, but they would be subject to increases in premium. And then finally in the news, there's what if you want to forget the whole thing, then you got so much money that you've paid up in premiums, and you can take the money and put it into an account and use it for long-term care, which I would say that's 5. Now in the current one, where they're talking about a 1% compound interest, you've got 2 already in that category. Where are you putting this? Which one are you pulling out? Or where are you putting this one? Is it one that's subject to premium increases, or is it one that's a stable lifetime?
My understanding, this is a new option that's not replacing anything, and it will be subject to future rate increases. That it's being slotted in right now. There's a 5% bio, there's a 3% bio, and there's no bio, and this is being slotted in between 3% and no bio at a 1% bio. But if you selected it, you would be subject to future increases.
When you use, sorry to interrupt, when you use the word bio, what are you referring to?
The inflation, I can't remember what bio stands for, but it's
Benefit
the
increase option.
benefit increase option, yeah.
Okay.
And so this is a new benefit increase option that would slow the rate of increase of your future benefits. But like I said, it's between the current 3% and the current no bio, where you don't get any inflation benefits. So it's a buy down option for you. but it would be subject to future increases along with the rest of the block of business. And Mr. DeRose, please correct me if I said anything wrong.
Yeah, no, you're correct. And just two things that I would add to that is one. So historically, you point out was that Mr. Scott? Historically, the 1% bio has only been part of that lifetime stable premium option as part of that package. So now
Yes.
we're making that a standalone option. So you don't need to go down to the full lifetime stable premium package to get access to that 1% bio. So you point out that correctly. And then also, I just want to be clear too, we, in our policyholder letters, we do put a couple of what you call suggestions, but certainly options, but all option, when you call in to our customer service team, they will walk you through all available options, more than what may be put into the policyholder letter, based on some predetermined logic. But so those are not the only options available to policyholders. I want to make that clear that anything that fits your coverage needs and financial situation is certainly available. So encourage folks to call into customer service and have those discussions.
Okay, you are correct, Mr. DeRose, in that the 1% regards stable lifetime. However, there is no 3%, just to let Brad know. It's either 1% or 5% currently under this series. So the 5% would be where you have according to the alternatives in my page, the 5% would be where you are having policy increase potential. Okay. Just FYI. I don't know where the 3 came out, but so.
Well, and typically, again, what the options that we would put into the policyholder letter are what give you or any policyholder the best premium mitigation. So yes, the 3% may be available to you, but maybe not as much premium mitigation as going down to, say, the 1%.
Okay, well, I confess I'm confused. Why do you need to go to the MIA to present? If you have a broad range, why do you need to go to the MIA to get a new one approved? I'm confused.
Yeah, so currently we have the 5% and 3%, and then the lifetime stable premium option, which is a package. We need approval for the 1% as a standalone, and I'll let Brad make any additional comments.
I was thinking somehow that you were saying you can pretty much call in or roll your own policy there. So okay, whatever. In any event, I too have I didn't get the gentleman's name, but I too have presented in the past a spreadsheet to the Maryland Insurance Administration, which shows that starting from 2002, when we got the policies to date, we've had, starting in 2014, 15% increases throughout. So 2 questions. One is, if only a fraction of what is requested is being approved, is it still the 15% per year that's being approved? I mean, that, I'm getting kind of a sense from Brad, from you, that you have adjusted that down like to 10%. And I haven't seen that in reality on my policy. I just was curious as you could clarify that perhaps.
No, I mean, I think our average requested rate increase is over 100%. So when I say we're approving a fraction of what is requested, I'm saying we're approving more like a 30% average increase rather than a 100% average increase. But obviously a 30% average increase is 2 years of compounded 15%. So we are using the maximum rate increases that are available to us to get these rates towards adequacy. But the magnitude of the rate increases being requested are very large, and so we're still approving significant rate increases.
Okay, so again, looking at assuming I get to live till 2037, the policy that I'm with my wife that I'm currently paying about $13,000 for is going to be $62,400. if we continue to approve rates at 15% per year. So just letting you know, it's a simple math problem, but I'm sure at some point, we would have to just stop paying. It would not be possible to give to turn over that kind of money on a fixed income. Okay? And again, I have to look at the value of what it is that's being offered here too as well. I have not called into the customer service people. In any event, I will take a look at the options that are coming up and see what we're going to do. And I'm sure we'll be seeing Genworth back here in 2028 for an increase, seeing as they're currently approved through 2027. Thank you very much for your time.
All right, thank you, Mr. Scott. Next I had a Mr. Marshall Fritz who wanted to speak. If you want to unmute yourself, you can go ahead and give your testimony.
Yes, okay. Can you hear me?
Yes, I can hear you.
Okay. So, following up on some of the other testimony, the question is, what is the profit for Genworth in this division? And if there's a loss, and continuing a loss when stock market interest rates are now doing well, as opposed to some years ago when interest rates were nil, and I attended several of your conferences, and that was Genworth's complaint that we couldn't earn money on our investments. Well, now we've had 2 or 3 years of good interest rates, and what does that do to the the earnings of Genworth in this division, and how is that used to balance? And the other half of that issue is, if Genworth as a whole is doing well, and this question came up some years ago, why isn't Genworth other divisions providing some support to temper some of these increases or loss in your division? So that's a background issue. It's not the particular rate increases. And Mr. DeRose gave, I believe, a sample that there was a 67% increase in the policy for those who had the highest level, unlimited, and that's where I sit. But my policy has gone from 2,300 or 2,400 to now 10,400 for the coming year, and that's far more than 67%. And if you take 15% going forward, I could easily be having a premium of several $100,000 by the time I reach the age when my parents were old enough that they needed care. So we're talking about affordability, and even if I at some point decided to go with a certificate or downgrade, it would still be a tremendous premium going forward. When you talk about the 6 or 10 years of needing 180%, I think you say was the increased need. But that's only for this period of time. Going forward, have you not done forecasts to estimate, and it will be a rough estimate, beyond that period? In other words, are you ever going to catch up, even close to catching up, with what you know about conversions to certificates, use, age, morbidity, and such? Beyond that period, how likely is it that you wouldn't need even more substantial increases? So your forecast is self-limiting for this period of time, which I can understand. You say for this period of time, but you actually are misleading that we wouldn't need anything going beyond that. It's highly likely you would, given the trends you're talking about. So the other gentleman said, brought out for I think the other company that the average age was 62 years of policyholders. Well, if that's true in the Genworth domain, as it is in the other company's domain, then we're talking about many, many years before most people are ever likely to need that service. And so, unless you're building in forecasts that have any semblance of realism going forward, it's not particularly helpful in trying to let the state understand what the needs of people for paying these premiums will be at that point. Let's see, anything else? Oh, and if you buy down to a lower increase level, what assurance do you really have that the increases won't be another 15% going forward every year? And not just for the highest level premium type. So, I mean, how much can consumers trust that if they buy down, they are somewhat capping it against their affordability? Let's see. And the more certificates you wind up creating, certificates where people freeze their premium level and walk away but keep their benefit active, that probably has an effect on Medicaid in Maryland, because most people who have done the certificate, if they need long-term care, will need a whole lot more than what that certificate covers. And it could be that it becomes, as another testifier has said, a worthless policy, because they can't really use it to maintain private services. They will be going on Medicaid. And so that doesn't help the state. And so when the state's balancing all these concerns, it has to look at what this is doing for the Medicaid component, because that's an unlimited state expenditure as such. So we bought these policies hoping that we wouldn't have to go on Medicaid. But clearly a number of your certificate holders are going to be going on Medicaid because there's not enough money in their premium pay. I mean, maybe 50,000, maybe 100,000, maybe 200,000 maximum so far. But that's not going to buy very much in long-term care if they really need it. And so after a few months of long-term care, they'll be on Medicaid, a high percent of them. And so that doesn't help the state. I mean, this is the balancing act, but the state has to be concerned what this does to the Medicaid costs internally. Okay, so that's some of the things I wanted to say. So thank you very much for the opportunity.
Thank you, Mr. Fritz. Appreciate it.
I'm not seeing any other hands or anyone in the chat, Brett.
All right, thank you, Craig. Then with that, we'll call our hearing to an end. Thank you very much for everybody who participated. We appreciate it. And public comments are open for another week. If anybody wants to submit anything written, it will be published on our website. All right, thanks very much.
Thank you.